Inflation in Singapore may be easing, but slower than expected. August reading shows core inflation rising to 2.7%, its first increase in 6 months. That's on the back of higher services inflation. Now, still, economists say the pace of price increase is expected to be stable for the rest of the year. Bahajjaj with more.
A stronger Singapore dollar spurred more to purchase package tours in August, which boosted holiday expenses and lifted services inflation. On the flip side, housing rental growth slowed, along with cheaper car prices due to a projected increase in the certificate of entitlement quota. This prompted headline inflation to dip to 2.2% in August from July's 2.4%.
For the man of the street, of course, moderating inflation should be quite welcome. But I think in general, if the overall economic environment is one where growth prospects are softening, employers are a little bit more hesitant on hiring, and also in terms of paying out wage growth, that also could, potentially mean that consumers may start turning a little bit more cautious and, be a little bit more restrained in terms of their spending.
Recent escalations in the Middle East are also prompting fresh concerns that inflation could ramp up again.
If there's any escalation in terms of the geopolitical conflict on a more broader geographical basis, that has the potential to cause delays in shipments, to drive up commodity prices like food and energy. And as mentioned, right now the food and energy prices are relatively low and benign. So if they hit up again, then there's some potential to cause a rebound in inflation once again.
With the Federal Reserve making a 50 basis point cut in lending rates, Mr. Ng says this will help to boost spending in the US and keep the global economy relatively stable. This will help to maintain some stability in Singapore's inflation. It's why economists think the central bank's monetary policy will remain unchanged in October.
Policymakers will probably look past this recent uptick in the core inflation and the services inflation, and they remain fairly confident that core inflation should continue to subside, especially out into 2025, where they are looking more at the 2% handle.
For the full year, headline inflation is expected to come in between 2 and 3%, which is lower than the 4.8% seen in 2023.